Let's review the data and the news which came out throughout the week. Based on the data and the news, I'll try to make a prediction on how the market will move in the short to mid-term. Now, first on the data. Core data that came out this week include December consumer confidence data, new home sales data, and initial jobless claims. Now let's look at the data one by one. On December 23rd, the US consumer confidence data came out for the month of December. Consumer confidence data measures the level of consumer confidence in economic activity, which means it measures how comfortable they are in conducting consumption activities on a day-to-day basis. This is a leading indicator, so it is a good way to predict how the consumer behavior will evolve in the near term. If you look at this table, consumer confidence for December was at 104.7, which was lower than the forecast of 112.9 and lower versus the previous month, which was at 112.8. Now, what this means is that while the backward-looking indicators like the CPI, core CPI, were indicating the consumer activity is very strong, forward-looking indicators, which is the Consumer Confidence Index, is showing less economic activities in the near term. This basically means that in the near term, consumption may show a drop in activities, which may lead to a milder CPI and core CPI in the near term. For the Federal Reserve, this means that they may have more room to lower the interest rate to boost the consumer confidence, which indicates that there may be more liquidity provided to the market by the Federal Reserve. This is also indicated in the Federal Reserve's potential rate cut probability in January. While the probability of a rate cut in January was at 8.6% last week, it increased by around 2 percentage points to 10.7%, showing the market's stronger confidence towards a rate cut. However, as you can see, the probability of the rate remaining constant is still at around 90%, indicating that a rate cut is still very unlikely. The second data that came out is the new home sales data. Now, as I've been saying all along, home sales data is very important during times like this when the inflation is sticky, and a big component of the inflation metric is shelter, which is related to the demand for homes. If you look at this data, the new home sales for November was 664,000, which was in line versus the forecast of 666,000, but higher than the previous month, which was at 627,000. Now, what this means is that the demand for homes is still quite strong, which will potentially keep the inflation high for longer. I'd like to see this data dropping to around mid 500,000 level, which is similar to pre-COVID-19 days, for me to get assurance that the inflation is now more likely to be controlled. Third data that came out is the weekly initial jobless claims. Last week, the initial data was at 220,000, and this week it remained almost the same. If you look at this data, the initial jobless claims for the fourth week of December was at 219,000, which was slightly lower than the forecast of 223,000, and in line versus the previous week, which was at 220,000. This indicates that the job market is still strong versus the expectations, given there are less people losing jobs. Therefore, this will potentially continue to act as a burden for the Federal Reserve to lower the interest rate faster. As I mentioned last week, people losing more jobs will indicate that the economy is doing bad, and with the economy doing bad, the Federal Reserve would have more means to lower the interest rate to boost the economy. So with all that, the S&P and Nasdaq were both up throughout the week, with S&P up by about 1.8% and Nasdaq also up by about 1.8%. The market went up at the start of the week, reflecting the more positive outlook on the rate probability going down faster, supported by the weak consumer confidence data. Also, while there's no accurate correlation, there's generally a belief that there's a market rally towards the year end called the Santa Claus rally. This basically is known to capture positive expectations during the year-end season when shopping activity increases and seasonal optimism kicks in. This may be a myth, but sometimes it plays a role in the market sentiment. But today, the market went down hard, reverting a lot of the gains during the week. This was mainly due to the treasury yields, especially the 10-year treasury yield, still hovering high, reflecting the market's concerns on the high inflation. So with all that, the market was up during the week. Now let's put that all together and see where we are. Let's look at the Federal Reserve table. Taking into account of what happened this week, consumer confidence index was weak, which indicates that the interest rate cut may speed up a little bit. Number two, new home sales data was still stable, indicating that the interest rate cut will be slowed. And number three, initial jobless claims were weak, which means that the interest rate cut will be slowed. So taking all that into account, my thesis still holds that the Federal Reserve policy is gradually shifting towards Section D. I have also been saying that we should think about slowly shifting from growth stocks to defensive stocks like pharmaceuticals and financial institutions. With that, I'll end the market update, and for everyone who is watching, I wish you a happy new year. I'll be back with another market update next year.